Good afternoon, everybody. My name is Patrick Ajunwoko. I am the Executive Secretary and the Chief Executive of the Association of Corporate Treasurers of Nigeria. On behalf of the Governing Council and members of the Actn, I wish to welcome you all to this auspicious meeting. This webinar is being hosted by the Association as part of its objective to regularly hold programs on topical issues for the education and enlightenment of its members. It is actually my hope that we would have had a very fruitful discussion at the end of this meeting, and we will also try as much as possible to finish within the stipulated time. I also want to put that if anybody has any question as the discussion is going on, kindly tap your question using the Q&A button. The moderator will see it and will be able to address that question. But without much ado, I think I wish to invite the president of the association, Mr. Zeal Akarewe, to give a short opening remarks, and thereafter we will commence the panel discussions. Thank you very much.
Thank you very much, Patrick, and good afternoon, everybody, ladies and gentlemen. On behalf of the association, I wish to welcome you all to this webinar regarding the challenges of corporate treasury management, especially amidst the COVID-19 disruptions and the illiquidity we're experiencing in the market. There's no guarantee that this situation has accelerated the pace of transformational change within the treasury management space. And so in discussion today, we'll be looking at some of these challenges specific to the corporate treasury and how to manage some of these challenges that have been brought about by the pandemic. I'm glad we have panelists drawn from all across. We have the corporate sector, we have the banking sector, we have FMDQ regulator. So we have traders. Okay, am I back? I'm sorry about that. I think. Yeah. Anyway, as an association, we want to continue to strive towards organizing these type of programs to add values to our members and strengthen the corporate world. Recently, we conducted a short survey to understand the impact of the disruptions caused by COVID and the subsequent lockdown, especially as it relates to the specific treasury function. And the results revealed that there were indeed some challenges experienced by some members because working from home was not as seamless for everybody as we thought it would be. The result of the survey is a consent association, especially in the current situation, and in the near future, in the next month or two, looking at bringing up more discussions around changing the work environment and the role of appropriate technology in order to make working from home and even when we're back in the office more seamless. Wish every one of us a fruitful deliberation, fruitful discussion, and once again, I welcome you to the webinar. Thank you very much.
Thank you. Right now, I will go ahead to introduce the moderator for this panel session. The moderator for the panel session in the person of Mr. Funsho Shobande, which Shobande, is a multi-skilled banker. He has been treasurer of different banks at different times. He was also the chief dealer of the central bank. In fact, he was also the treasurer, a corporate treasurer. He is the founder of Interchange Group, and is also a member of the Actn Governing Council. Mr. Shobande was also a past president of the Money Market Association of Nigeria, which is now Financial Market Dealers Association, FMDA. It's my pleasure to invite Mr. Shobande to take up the panel session. Thank you.
Thank you very much, Mr. Joko, for the introduction. I'd like to also thank the president of the association for yielding the platform to conduct and moderate this discussion today. So I'd like to start by saying good day to all our discussants, speakers, and viewers that have logged in from various locations to participate in this webinar brought to you by the Actn. The topic under the searchlight is COVID-19 and the challenges posed to corporate treasury management. In essence, we want to find out what the impact of this pandemic has been on corporate treasury management. I have with me today the following eminent personalities that will be shedding some insight from their own perspective onto the topic under discussion today. Let me start by introducing the ladies amongst us. First, I'd like to introduce Mrs. Kudi Badmus. She is an executive director and CFO of Eterna Oil PLC. Ms. Badmus, you're welcome to this panel discussion.
Thank you.
Secondly, I'll be introducing Ms. Tumi, Managing Director, FMDQ Securities Exchange. You're welcome to this discussion. Ms. Sekoni is also a member of the Governing Council.
Thank you.
Then I'd like to introduce Mr. Sam Ocheho. He is the Treasurer and Head of Global Markets at Stanbic IBTC Bank, and also a former president of the Money Market Association, the FMDA.
Thank you very much.
We had invited and obtained a go-ahead on the participation of the Director, Financial Markets Department of the Central Bank of Nigeria, Dr. Mrs. Angela Sere-Ejembi. But unfortunately, at the last minute, she sent in her regrets and apologies. She had to be drawn to a national assignment, and so she will be unable to join us in this session today. However, we will be putting together a communique, and we will be sending that to her and hoping that she will participate in our further discussions going forward. So without much ado, I'd just like to set the context for the discussion today and then allow each of the panelists to speak for 2 minutes on their own perspective before we go into the discussions for the day. I'd like to restrict the discussion to the following areas as much as possible: liquidity and risk management, foreign exchange management, hedging opportunities in a volatile, uncertain, complex, and ambiguous situation, and all this to be discussed within hedging opportunities, all to be discussed within the context of the impact of the pandemic on the corporate treasury function. Indeed, corporate treasurers are working today perhaps through the greatest crises they've ever encountered in their careers, and under very unprecedented circumstances, under which even the best of contingency plans that we may have had in place may never have envisaged the kind of situation we're navigating through at this point in time. Globally, trade and commerce have slowed down. Most economies are starting to reboot. Corporate treasurers are being asked to fund operations for an indeterminate period of time, with certain revenues from customers, and also having to scrutinize the creditworthiness of their supply chains of the customers as much as before. Treasurers and CFOs operating under this terrain have to ask themselves some critical questions. How might business cash flows be affected globally as a result of this pandemic? They also need to consider how the banks they deal with may be affected. What are the implications on those topics I had earlier spoken about: liquidity management, foreign exchange management, funding of borrowing levels, keeping of covenants, and foreign exchange hedging. So this has refocused, most corporate treasurers on risk, and risk management has come to the top of the mind more than ever before. And those concerns are growing every day. So it is within this context that we want to have a discussion, and I'd like to, at this point, invite Kudi Badmus to give her own perspective on the challenges that she's been experiencing or she has encountered during this period of the pandemic. Over to you, Ms. Kudi Badmus.
Thank you very much, Mr. Shobande. Welcome to the webinar, ladies and gentlemen. It's really interesting to be here at this auspicious time in our, should I say, career or lives as it may be. As a treasurer and CFO, I think I don't know how many people on this webinar as we are, but it's really challenging. And the treasurer has been the center of all of this, as Mr. Shomade said. We've had to be funding transactions and operations without planning, so to speak. So our cash flow that we had planned beginning of the year, based on budgets, has been thrown out the window. We've had to fall back on even cash flow that you did not even expect that you would have, you know. For instance, we have our receivables that have gone down to 50% of what it used to be. So if you had plans that you expect some receivables with this specific period to bridge the gap that you have, that is gone. Even in terms of drawing on banks, you don't know how healthy the banks are. Everybody is sort of hedging their liquidity, and they want to be sure that either you are healthy or you don't even know how healthy they are. So in the course of planning, you're juggling a lot of sources at the same time. You also have stocks that are taking longer time to turn over. So typically you probably have your stock turnover period of 30 days or 90 days as the case may be, and it's taking longer to turn over. So all your sources of funds are sort of locked up. To make matters worse, some of us could not even access the banks during the lockdown. So even when you have money in the banks, they tell you we're not working or we're working from home, so you can't access except you have online banking. And if you have multiple banks, you probably will not have online banking for all of them. You know, so you have that on one hand in terms of your liquidity. So in borrowing, you've had to fall back on borrowing, and that is increasing your interest costs. And you're having to increase finance costs that wasn't in your budget at the beginning of the year, or that you did not plan to incur. So the gap are getting wider, and the uncertainty is getting more, you know, and those are the kind of challenges that we face. Then on the FX side, at the beginning of the pandemic, CBN revalued the currency, whatever name they called it, but we sort of had the devaluation of the currency, and you had to deal with the depreciation and the cost of this depreciation. So in also looking at it, you had that risk that even if you had envisaged it, you probably were hedged, or you're not hedged, or you're not fully hedged, but our FX risk also crystallized because transactions went more expensive in closing out, depending on what kind of position you had. It became difficult to close out. So you're dealing with increased exchange rates, and you're also dealing with the illiquidity at the same time. When we bid, we do not get enough funds from CBN. That is, if you're allowed to bid. Some of us in the oil and gas sector, you have a long maturity period. So within 6 months of the maturity of the transactions, you're not allowed to bid. And you have to go to the wholesale markets or I&E windows that are not even available. So these are some of the challenges that we've had to deal with over this period. Exchange rates risk crystallizing, interest rates going higher, our cost of financing going higher, illiquidity in the FX market, and just juggling different sources of funding as it may be. So these are some of the challenges we've had to deal with. But with time, I guess we would look at how we've been able to manage some of this risk that we faced. Thank you.
Okay. Thank you very much, Ms. Badmus, for that insight. I think you've really hit the nail on the head. And I think at this point, I'd just like to invite Mr. Sam Ocheho. He is on the bank side of the divide. So yeah, I want Mr. Sam Ocheho to give us his own perspective of the challenge and perhaps maybe possibly address some of the concerns Ms. Badmus had said. Some banks were difficult to reach online. Some banks, you really had to reevaluate your own standing. Who is actually more liquid? Am I more liquid than the bank? Is the bank actually going to pose a threat to my own business? Are they able to source sufficient funding lines and so on and so forth? So over to you, Mr. Sam Ocheho.
Okay, thank you very much, Mr. Shobande. Thank you for the opportunity to talk. And thank you to all those who have made it for this webinar. I would just like to look at things, first of all, generally, some of the subtopics we have centered around liquidity risk and liquidity risk generally. And maybe in a brief way, I just want to look at what liquidity risk is. Liquidity risk is defined as that risk that a firm, though the firm might be balance sheet solvent, cannot maintain or generate sufficient cash resources to meet its payment obligation in full, and as at when they fall due, or can also do so, they may be able to meet that liquidity at a materially disadvantaged terms. And distinction needs to be made between the funding liquidity risk and market liquidity risk. Funding liquidity risk refers to that risk that counterparties who provide the bank with funding will withdraw or not roll over the funding. Market liquidity risk refers to the risk of a generalized disruption to asset market that makes normally high liquid asset become illiquid, and also potential loss through the forced sale of assets resulting in proceeds being below the fair market value. But few things I need to highlight in these times, in the time we're in, when in unprecedented times. Corporates are now forced to work from home as a result of the COVID-19 pandemic. The truth is, only few institutions probably prepared for a thing like this, not in this magnitude, but few institutions are prepared contingency scenario. They also have their business continuity management scenarios, and also probably had disaster recovery side. But what I think one thing that Nigerian corporates or Nigerian institutions didn't really plan for is the ability to work from home. And this the COVID-19 pandemic has clearly brought that to the fore. And every one of us, whether we like it or not, need to review our policies to include work from home policies. Yeah, talking about liquidity in these times, I mean, we've seen markets rally, we've seen market tumble, we've seen different type of price wars happening in the market. Trade wars also happening all over the world, as exemplified by the US and China, especially. Also, banks have come to appreciate risk management the more. We're seeing banks applying more risk management tools. Country risk is now a greater focus, especially for the offshore institutions who are doing cross-border activities. So people are beginning to scrutinize country risk and adding some premium for different countries, depend on how they see the country in the curve. We've seen downgrade of sovereign, and all these have affected liquidity in our market. Nigeria was recently downgraded, and as a result of that, people who had cross-border trade, because most times when you look at financial covenants in all this cross-border trade, there are always clauses around the grading of a sovereign. And if that happens, you might see some banks, some of these offshore institutions calling back their fund, or they could look at a waiver request from the borrowing institution, and you probably pay higher fees. We've seen that happening in these times. We've also seen central banks across the world taking different measures to try to protect themselves. We have seen our Nigerian central bank taking measures around the reserves, around foreign exchange management, in terms of not wanting to deplete the reserves so that they can meet needs. We've seen imports suffering. We've seen different FX need suffering at this point in time. And like I mentioned earlier, the work from home conundrum, some banks survived it very well, but some institutions did not survive it. So if I was to respond to what my colleague, Ms. Badmus said, yeah, I mean, there are issues here and there, but some banks were able to work despite the fact that they were working from home. Online connectivity was great. They were able to make payment, but some banks probably had issues because they were working from home. So it depends on the level of preparedness of every institution. I think the key thing is NGN liquidity has been very good. If you ask me, I don't see corporates borrowing much at this time, and the simple reason for this is I don't see corporate expanding much in times like this. But I think where they've had more issues in terms of those that needed foreign currency, especially foreign currency borrowing, the banks are also in that, suffering that issue. Why am I saying that? The banks are probably borrowing off dollars or foreign currency principally from offshore. At this point in time, most of the offshore institutions are not lending cross-border. They're not lending to Nigeria. Let me use Nigeria as an example. So they're not lending to Nigeria. They are not rolling up existing facilities. And so banks are also struggling to pay on their obligation because of the reputational risk that will follow non-payment. So the banks are also in their own issue. And who takes the brunt? Most of these borrowings were lent to clients. So the banks will also be demanding repayment from the client because they have to pay the obligation. Confirmations of lines of banks are not being rolled over. Most confirmation banks are cutting down on this line. Hence, corporates want to do LCs, and then you find out that the banks are refusing new LCs, except probably cash collateralized LCs. It's not because the bank does not want to do more business, but because the banks have to appreciate the current risk environment, measure their own ability to repay on this loan. And then, if you look at what were the usual sources of FX into the Nigerian market, the usual sources of FX into the Nigerian market, as we all know, were from oil companies, from exporters, from multinational institutions, from the offshore portfolio investors, from NGOs, from remittances, and principally from the central bank. All the other sources I had mentioned are clearly next to nothing at the moment. Offshore guys are not coming. Exporters have one issue or the other. There are COVID-19 excuses, so they're not bringing in dollars to the market. The multinational institutions are not expanding in Nigeria. They're not bringing in dollars. They're not offshore portfolio investors have stayed out of the Nigerian market because the funds are still trapped in the country that have not been able to externalize. So the question is, why would they bring more? NGOs are not bringing as much as they used to bring. Even remittances, individual remittances from friends, parents abroad is also suffering. So central bank remains the only option for flows at this moment. And if central bank is not providing, then there is a major problem for the flows market. So you can see why there are a lot of issues around FX liquidity, why corporates are complaining and also telling the bank that the banks are not doing what they need to do. But I think I'll just stop for now and then we'll take it off from there.
Thank you very much, Mr. Ocheho. That was a real in-depth analysis you gave there. You know, the perspective from the confirmation lines, borrowing lines, and issues like that. The FX sources being challenged, and there's a lot of ramification around this. I think whenever there's a problem like that, people look forward to the solution providers. It's rather unfortunate we're unable to have the director FMD with us today, but we do have somebody who is also well placed to comment on the kind of respite people will see from the economy in terms of the sources to find protection from the risks they find themselves having to battle. So I'd like to ask Ms. Tumi Sekoni to comment briefly on the kind of protection from both interest rate risk, liquidity risk, and foreign exchange risk that is available in the country. What hedging opportunities are available to the corporates today? What options do they have as they try to battle with this crisis? Over to you, Ms. Tumi Sekoni.
Thank you, Mr. Shobande, and good afternoon, everyone. Thank you for attending this webinar. Thank you, my fellow panelists. So the respite, and I think I like the word you use, solution provider. FMDQ, I wouldn't call us a solution provider, but the platform that, if you will, facilitates, the solutions that have been provided by the market participants. And not to put Sam on the spot, but a lot of these solutions will come from the banks. As everyone has said, really, this situation has impacted pretty much every institution, every sort of sector, well, not every sector, but most sectors, most areas. It's actually touched one in some way or the other, and that hasn't left, that hasn't sort of protected, even if you will, as in if you will, the exchange. What the exchange tries to do is, or what we try to do during this period, and what we're still trying to do, to ensure that the platform, the market, still remains open as much as possible. As Mr. Ocheho has spoken about, working from home and things like that, we also adopted all of that and tried, as much as possible to make sure that the platform and the avenues were available for trading, price discovery and all of that. And of course, from our position, we're able to see the impact it's had on the market, and pretty much what has been said by the panelists, we were able to see that almost firsthand. Now, with respect to what is available in terms of protection, what's currently is in, especially the OTCFX futures product, but as most people would know, most certainly the banks, that doesn't protect you from the liquidity risk. A product that would probably have protected you from the liquidity risk, I would say, probably have been a forward. And the provision of the forward contracts really at this point would be the banks. But as Mr. Ocheho had spoken about, they are also faced with challenges that mean it might have been difficult for them to make some of these commitments. Now, of course, if you had probably entered those transactions way before the pandemic occurred, you might have been in a better position. And I think what this has done is made us see, whilst we've always known it, I think this situation has made it more apparent why it's very, very key to have hedging products in the market. FMDQ is, we've been working on a derivatives market development project where we're looking to roll out a few derivative products. Hopefully this year, we would have actually had made more traction, but for the COVID-19 pandemic. But it is what we're seeing is these products have to come to the market to address what you said, interest rates, to address the FX risk, to address even liquidity risk. So the problem with speaking about hedging products when the risk really crystallized, it's almost like it's what do you do at this point? Any hedge you go into now is to protect you for the future, not necessarily protect you for the risk you've already gotten yourself into. But it's not to say that they're not lessons learned, as you've said, and it's what we have to focus on. When we come out of this, whilst it may not be very quick or painless, at least we know that we have something. We have areas that we need to focus more on and see how we can ensure, obviously working with different market participants to roll out all these products that would have protected the corporates, at least to some extent, as had been said earlier by the panelists. This situation is unprecedented. I'm not sure any one of us has experienced something like this in our lifetime, and maybe we may not necessarily have had the full products the products to actually cover everyone fully, but at least there would have been some sort of protection, some sort of respite. From again, so the exchange, we're working again closely with the market participants, the banks, even the investors. We are, as much as possible, working, doing relevant advocacy, because some of these issues that have been spoken about, they become more apparent, and especially in this dire situation, liquidity, especially in the FX market, which impacts everyone, is really, really dire now. And what product do you have now to address liquidity? You probably wouldn't even find that in the market today. Okay. I think someone is on mute there. So you probably wouldn't find that in the market today, but work together with the banks, the treasurers, speaking about, what we can do for, going forward, and even now, is something that the exchange is championing. That's so in terms of the OTCFX features that I started speaking of, whilst that would not address the liquidity risk, what it would address, at least what the product was built for, is to address the rate risk, the FX rate risk. And as Ms. Badmus has said earlier, the devaluation. So the futures product would cover you and hedge you against, devaluation risk. And so there's no late time necessarily to go into those futures. So for corporates even looking for respite in this situation, would advise that maybe they consider, the OTCFX risk product to be able to manage, that at least risk on the risk side.
Okay, thank you very much, Ms. Tumi. Let me just say at this point, just reacting to a few things you've said, that there have been concerns about the impact of FX availability against imports. As precautionary measures, certain customers took out non-deliverable forwards against some of the LC obligations, but have a concern that upon the maturity of the forwards, there's uncertainty on the liquidity being provided by the I&E market to liquidate those obligations. Are there any specific measures that, can be taken to improve this liquidity in the I&E market?
So maybe the sort of things that would say potentially improve liquidity in, say, the FX market, like Nigeria, like ours, is maybe looking at transparency. How much can you open the market, so that people are willing to bring in, their monies, because they know that when they want to come out, they're able to come out. So improving liquidity, there are quite a number of different factors, and we know what's happening in the crude space, as Mr. Ocheho had spoken about. The sources of FX liquidity pretty much have dried up now, and those are the areas that would have helped the liquidity in the I&E window. The central bank, who was probably the largest provider, as was said earlier, for FX liquidity, also is being faced with its own challenges. So improving liquidity in the market, I think it's going to be a function of the different economic. COVID-19 pandemic has had an impact, and at least the good news is, businesses around the world, economies around the world are beginning to open slowly, and I think that liquidity we are expecting and hoping would see come back gradually, maybe not as quickly. So for those who went into the OTCFX futures products and their contracts have matured and they're not able to source, spot FX in the I&E FX window, what's from the exchange's perspective, what would happen with that product? So say there was settlement amount due the client, because we understand what is going on in the market. What would happen is that settlement amount would be held on until the client is able to purchase spot FX. Now, I know that doesn't really answer the question of how do they fulfill the obligations, but I think with what is going on worldwide, there might just have to be some respite from the other end of maybe those that the clients have obligations to see how can they extend timelines and things like that. And from our perspective, we're also looking at, engaging the market, looking at the current conditions to see if at all there's anything that can be done, to further support. I mean, as much as is practicable, especially looking at the requirements of the products and things like that. If there's anything that actually can be done in that situation. But about liquidity, it's back to the market participants, back to the different macroeconomic factors, back to when will economies open again, and when will we start seeing some flows. Of course, that has to be supported by a transparent and open market, so that also encourages even these flows coming in when the time comes.
Thank you for your response. I'll just go over to the duo of Sam and Kudi with one more question before we start taking questions from other participants that are logged on. And basically, what I would like them to speak about is the various palliatives that have been in the market ever since the pandemic moved into the Nigerian space. We've seen a lot of palliatives being taken both locally and globally. And a lot of these palliatives revolve around making liquidity relatively cheap. My question is, in the view of this supposedly cheap liquidity floating about, do we not run a huge risk of the risk being mispriced at this particular point in time?
Okay, I will try to give an answer to that. I don't think there's any bank or any institution that wants to go into business for the sake of losing money. Yes, there have been various palliatives by central banks. Central bank has met with bank CEO through the bankers committee, and they've discussed various measures around to create respite for the sector. And I think some of the few things that have come up is interest rate reduction, putting a moratorium in place, some of the loans, also being able to access the CBN window, some sort of funding to the corporate. And these banks, different corporates have been able to approach banks. Some of them are in discussion with their bankers to see how they can reduce the current pricing on their loans. And I think the market liquidity and the interest rate environment in the market at the moment, really supports a reduction in the prices of the loan. But the danger is that deposits also have to be repriced, because the banks probably need to be able to meet some spread to be able to meet operating expenses, and so that they can also continue as a going concern. So as they review the asset side, they're also looking at the deposit side. And if you notice, there's so much liquidity in the market now that at some point banks even have investable outlets to put this on. And it's got where banks are even turning down deposit. But the window, what I'm trying to say is that the window is available for the corporates to approach their bankers to be able to look at repricing their loans, and also look at requesting for some moratorium or in terms of interest and principal repayment. So, and I expect that banks will take a good look at that as corporates approach them. Thank you.
Okay, Ms. Badmus, what would you say about the probability of this liquidity being misallocated, in short, creating a moral hazard problem as a result of the fact that there's much cheap liquidity around?
Right. Thank you for the question. To me, I really do not think that there can be too much liquidity, especially when it comes to business. Reason being that the cost of doing business is so high, and the highest cost, especially when you have a large need for funds, is usually the finance cost. So there can't be too much. As far as the corporate is concerned, you can't have too much liquidity. If anything, you have constant liquidity shortage, you don't have enough to fund your FX. As Mr. Ocheho would allude to, if you want a 10% FX allocation from CBN today, you have to fund it 100%. So there's constant need for funds, and you're having to pay a lot more for less, you know. So from the corporate perspective, you really can't have too much funds, if you ask me. At least as far as the current position is concerned, and most of the reduction in the cost that CBN is offering is more towards SMEs, and they are even more vulnerable. So I think it's a good thing. I think it's good that they're doing that. They hire the larger corporates. They have more markets to get funds from, but banks don't typically lend to SMEs that CBN is looking at palliatives for. So I think it's a good thing, and I think it should be encouraged.
All right, thank you very much. We're going to start to wrap up the discussion from the panelist side to allow our viewers to ask some questions. But there are two things I must do before we start that. I'm going to ask one question, and then I will present a few snippets of the survey that was carried out by the Actn, which the President spoke about for the benefit of our listeners today. The question is, outside of the cash and liquidity management, which is considered part of the DNA in any treasury, to what extent has having the right treasury management system in place helped in addressing the challenges caused by the COVID-19 pandemic from your perspective, both from the corporate side and from the bank side, and even from the side of the platform providers, FMDQ? Very briefly, who's going to go first?
Okay, if I may go first. From a corporate perspective, the tools that we have are still rudimentary, but to a very large extent, they have really helped in this pandemic. And what do I mean by that? Even though we still use Excel to do our cash flow and all of that, but you're able to at least know your gap. You're able to do a gap analysis. You're able to do a sort of sensitivity analysis and all of that. And also the risk management that some of us have in place has really helped. So you already have limits for some gaps. And now that you have the pandemic, you have a maximum exposure that is crystallizing. So I think that having tools would be very helpful that are more dynamic, that are more flexible, and you can do a lot more sensitivity analysis with. But you really can't underscore the need for some of those tools at this time, and they have really helped some of us, if I may say so.
Mr. Ocheho?
Yeah, from my own end, I think the best thing to have at this point in time will be to have appropriate treasury management systems in place. You must be able to, in a bid to measure and assess your liquidity risk properly, one of the guiding principles is that companies must have adequate information system for measuring, controlling, and reporting liquidity risk. Yes, I know it's a costly system to have, but if you appreciate risk management and you appreciate the fact that liquidity, it can be a going concern issue for your institution, my own advice is that every institution should try as much as possible to invest in the appropriate treasury management system. It helps them, and it has helped a lot of us in times like this, especially in this COVID-19 period. It has helped us to create do a lot of sensitivity analysis. It has helped us with scenario planning. The liquidity risk also impact on capital and the likes. So it has helped us create scenarios to even see if the valuation should get up to 600 for 1,000. Those are good for planning. And without the appropriate risk management tools, without the appropriate treasury management system, it becomes difficult for you to do this modeling. And so my general advice is that every institution should try their best within their funding ability to be able to get a proper treasury management system in place so that it can help them for planning purposes.
Thank you very much, Mr. Sam. Tumi, comments from you before we throw open to the public?
Yeah, so I actually agree with my fellow panelists. For Actn platform, we are also a corporate organization, and those things are also areas that we looked at to ensure that at least we start talking about. With respect to managing liquidity, it's very apparent because we are in a group structure. That is very apparent in our clearing business, in our clearing business and clearing side of things. Whilst and from the corporate perspective, for the finance side that actually manages the finances of the entire group. So I agree with what the panelists have said and how having a proper trade management system would actually help you and sort of support you and make things maybe, if you will, easier in times like this.
Okay, thank you very much, panelists. I'm now going to present a brief survey. The results of the survey that was carried out by the Actn. Just prior to going into the Q&A session, we already have a few questions building up under the Q&A chat session. But very briefly, some of the salient aspects of the survey that was carried out by the Actn. A question was asked about how easy it was to work from home, and 63.3% found it, of the corporates and the respondents to the survey, found it easy to work from home. 36% found it difficult or next to impossible working from home. In terms of the ability to originate and make payments from home, 51% found it convenient to do so. 12.2% found out they had to go to work to be able to initiate payments. And those who had to physically contact the banks to make those payments. And then there was 30.6% who couldn't make the payments at all. They couldn't originate the payments remotely. 34.7% of the corporates were SWIFT compliant and could use the messaging system to do their business. 65.3% found it difficult to do so. And in terms of the composition of the respondents, we had 28% responding from the consumer goods sector, 28% from the conglomerate sector, 12.5% from the building and construction sector, and 6.25% from the industrial sector, and 6.25% from oil and gas and telecom services sector. So that's just to show you the status of things. We expect that whilst we hope and pray that there will not be a second wave of the pandemic, it's something that we cannot completely rule out. And we expect that various organizations and institutions will rise up to the challenges to see that should there be a second wave of lockdown, we are better equipped to face the challenges that would be thrown before us. So now it's 12:54 p.m. We're going to take questions from our viewers and participants on the webinar. The first question will be taken today. Somebody has said, what is the level of security in place that will encourage online and digital banking? This, in my opinion, is not only capable of reducing, but creating easy access, making us work efficiently. So there is clearly a concern for the amount of security in the so-called transition to embrace digital banking. So how can those concerns be addressed?
I guess for me, what I think around that is that there needs to be more education around information risk management. our natural ability. I think a lot of us are beginning to appreciate information or technological development in Nigeria the more. A lot of us are still afraid. We're still afraid of anything technology, and rightly so, because there's been so much education around people need to protect their information, people need to protect their passwords and all. A lot of people still do not believe that the sites are adequately secure. But I think as much as it's still susceptible to fraud, most institutions are building up their technology more. They are creating more security. Even the central bank is beginning to talk more around the information risk management tools and trying to get banks to create more security around it. No bank also want to be liable to fraud kind of litigation or issues around missing money or people hacking into account. So every institution is creating more layer of security daily. And I think there are loads of payment in billions going through, if not in trillions, going through this system. We just need to appreciate it more and know that people are putting more layers of security in place to protect themselves and also protect their customers. But the world is going there anyway. So it's either you choose to go that route or you choose to be left behind. Thank you.
All right. This is a question that I think the person who has asked the question, Mr. Frank Elias Chatat, he has asked a question, and I think it's directed towards Ms. Sekoni. We have seen futures prices move lower in the past 1 week. What can you tell us about the driving factor behind these moves? Then the second part of his question is that Ms. Tumi mentioned that settlements are held for futures contracts that have matured pending corporates' purchase of the foreign exchange. How will the FMDQ address the slippage between where corporates can access the FX liquidity and the fixing on the day of the contract's maturity? If you want me to repeat, I can repeat the question.
No, it's fine. I
Right.
I got the question. So the first one, with respect to the pricing of the futures. So the central bank determines how they're going to price their futures, because they're the ones who are offering the futures, so the sole seller of the futures products for the moment, and so they determine what the price would be on a day-to-day basis. So we wouldn't have any on inclination or comment or understanding of what's driving the prices. Then with respect to what we're doing with the slippage. Now, I think I alluded to earlier in the session where that's the product does have limitations. You know, there are things that it's not able to address. And because of the peculiarity of the product, so there were different measures put in place to ensure that there's no speculation and things like that on the product. So what the rules do, or what the standards allow for? There are indeed some sort of underlying transactions that's they've used to go into the contracts, in the futures contracts, that allowed you to hedge the exposure again, following maturity. Now it depends on the underlying transaction. To hedge the exposure again, what happens is you might just have to forego the settlement amount if it was due you at the time period. So you might have to forego the settlement amount for that initial contract and then go into another contract just to hedge yourself. But aside that, if your transaction doesn't qualify for that, aside that, you probably would just have to, the only thing that could happen is your settlement amount is waiting for you until you purchase spot FX. Now, if unfortunately you purchase spot FX as a higher rate than the fixing price on that maturity date, then there's not much the product can do about that. And same thing, even if you purchase it at a lower rate, you just get your settlement amount. So where it's a higher rate, I guess you've gotten something in the settlement amount towards that differential. And if it's on the lower side, it's just settlement amount you get. So, like I said, it depends. There's some where you go into another futures contract to cover yourself, but that depends on certain criteria. And then on the other hand, where it doesn't qualify, you just have to wait until spot FX is purchased.
Okay. Thank you, Tumi, for that answer. I just want to let all the participants know if you have a question to ask, just click on the chat button at the bottom of your screen and type in your questions. We'll still be taking some questions and answers now. Just in case you didn't know where to go to type in your question. Again, we have yet another question that says, it's actually a question by the same gentleman who is asking for a view on the dollar naira or the noodles rate between Q3 and Q4 of 2020. I think he's asking somebody to take the role of a soothsayer here. Anybody want to stick out on that? Where do you see the noodles rate going, and what actions do you think would be necessary to support that?
I'll try and answer that. I guess I'm the trader here, so I'll try and give my own view. And please note, this is strictly my own view. It is not the central bank view, neither is it Stanbic IBTC's view. It is my view. And for me, I think there's still more demand than supply in the market. And the way I see the market, the central bank is very concerned around its reserves, even though in recent time reserves have increased because of the IMF funding that came to Nigeria. But still, we can see that the reserve is still being guided. Hence, they are not selling as much as they should sell, either to the local corporate or the offshore institution. If I look at the amount of outstanding sales to offshore, I think it should be between 1.6 to $2 billion that have been sold. There's still a lot of import demands that have not been met. Yes, one would say the central bank, after all, has 36 billion in its reserves. Yes, it might have 36 billion, but the question is, what base level do they want to have, and how much do they want to really spend out of it? I personally still think that there's still a room for a 5% devaluation or so before the end of the year. That's my own personal view.
Okay, thank you very much for that. Another interesting question here. Folashade Kolaeke has asked, and her question goes forth. Central bank has been repricing the OTC futures more regularly, raising prices until the last repricing where the rates were reduced. Won't these actions cause investors to lose confidence in this instrument?
And I guess maybe Mr. Ocheho can come in since he's the trader, but I don't think it would cause investors to lose confidence. Because I think because what has happened in the past is the central bank hadn't actually done any repricing until maybe a maturity. So it's always maybe monthly priced every day. So when they choose to stay with the current prices, that's the decision they've made. I think the repricing is just based on their view of what depends on why they're doing all of that. But having prices change, rates change, that is normal in any market. Especially a market that is activity, you see that the rates and prices don't usually necessarily stay the same. It's sort of evidence of what's going on in the economy and all of that. And if anything, it should actually bring more confidence to the functioning of the markets.
Okay, thank you, Tumi, for that. Sheye Akinola is curious to know what are the panelists' thoughts around the paradox of high levels of market liquidity coupled with high emission, i.e. high negative real returns for investors across asset classes. And he's asking, how do we think what are the thoughts around asset allocation in this sort of market? So high levels of market liquidity coupled with high levels of inflation, implying high negative real returns for investors. And the question is, what is our thought about asset allocation in this kind of climate?
If I may go first, well, depends on where you're coming from. I think for an investor, yes, it's a negative return, and you are really concerned about the yield on your funds. But I believe that what the CBN is trying to push is the real sector. They're trying to push funds to the real sector. I remember when the Governing Council sat with one of the former CBN deputy directors, and he was concerned about the fact that the real sector is putting money more in investment than in the real sector. So what they want is go use the funds to generate goods and services, put it in manufacturing or farming or whatever. Then you get your real returns. It is not meant to be in instruments, and which is why I think they feel more foreign investors that are bringing in their funds than local investors. So it just depends on what side of the divide you're at. But bottom line is that there are still areas where the money can work for you, and that is if you put it in real production, which is what would really grow the economy at the moment.
All right. One of the other questions we have is Mr. Bashiru Adiromu has asked a question. We've had a lot of reliance on imports, and it keeps hitting us hard anytime there's a global crisis. How much genuine and sincere efforts is being put into eliminating or reducing the reliance on imports for foreign exchange?
If I may answer, I think we tend to believe most times that diversification depends on the government alone. I think it depends on all of us, even as operators. Every one of us wants to take the easy way to import. We don't want to open factories in Nigeria or do stuff in Nigeria. But again, I understand the cost of doing business in Nigeria is very high. So in a bid to fix a lot of this issue to make the environment conducive for people that want to do backward integration, yes, the infrastructures need to be right. The issue around power, all the issue around power and its tariffs all need to be fixed. And then all the issue around having to grease palms and all those, the corruption needs to be fixed if we really truly want to diversify. The government has come up with different measures, say the central bank trying to stop allocating FX to a lot of import items, which led to the ban on the 41 or 43 to 45 items. The question is that really working? Are Nigerians willing to go the hard route? I think we're all still paying lip service to it. The government in its own way is trying to work, but then a lot of other infrastructures are still not there. So what the government is trying to do with the right hand, they are also taking away with the left hand because the enabling environment has not been provided. But the truth is, we have to get to a situation where we cannot continue to depend on oil or importing things. We need to be able to diversify. How many of us want to buy a locally made product? From the shirt we all wear to everything we use. there are a lot of producers in Aba. How many of us are wearing the Abami dress? So I guess generally we're all still paying lip service to it.
Thank you, Sam, for that response. I think before we wrap up, because we're running out of time, there are two questions I want to ask. Somebody has said that, and I think the question was actually prepared to be responded to by the representative of the Central Bank of Nigeria. So whichever of the panelists is going to respond will be given their own personal view. Nobody can hold brief for the Central Bank here today. The question is, will the Central Bank improve supply to pre-COVID-19 levels? It's talking about supply of foreign exchange. Or will it remain some sort of moderate intervention until it's able to clear backlogs in demand for foreign exchange? That's the first part of the question. The second part of the question is, what is the CBN's tolerance level for this level of liquidity in the system, for the depressed interest rates that will prevail for the next 3 to 6 months? Tumi?
Well,
Did I see Tumi reach out for her mic there? No? Kudi Badmus? Okay, Mr. Akarawi, our president. President, let's hear you on that.
Yes, not sure I had a feeling you were going to ask me that. But I think if you understand the sources of foreign exchange for the country, it's pretty easy to tell what will happen. Most of our foreign exchange, at least 80 to 90% of our foreign exchange, comes from sale of oil. Average oil price for the OPEC basket in April and May, $18 and $21, if I remember correctly. We also need to understand that the cash flow from sale of oil has a lag of at least 6 weeks. So the oil you see today, if you sell the oil today, the actual cash flow happens about 6 weeks. So for this month and next month, maybe August, the cash flow from oil proceeds is based on the oil price of April and May. Average oil price for April and May was somewhere between $16 and $20 a barrel. Oil production at 1.8 million barrels a day for 30 days is it's not a lot of oil. So when you do the math, we are expecting from oil $1 billion in April, maybe $1 billion in May. $1 billion from the sale in April and May. So we'll get a cash flow of $1 billion in June, cash flow of $1 billion in July, maybe a little more in August. So the cash flow position from a foreign exchange perspective is not going to improve as a country. However, the World Bank did advance us a $3.5 billion loan last month. So when you look at it from a cash flow position, the central bank is really juggling 3 balls with just one hand. It's very difficult. But there is nothing that seems to show that there will be a significant improvement. As long as the central bank is able to communicate properly with the market and manage the cash flows, the backlog may not increase, they will not clear it before July, unless there are other plans to generate cash flow from other sources that are that's not yet public information. So I hope that answers it.
Yes, I think that does it justice. I think I'm going to start to wrap up the session. I just wanted to comment on how the Association of Corporate Treasurers can assist the central bank in ensuring that the demand for foreign exchange happens in an orderly manner, such that the central bank can plan to meet, the demand that they will see at the window as the economy starts to come out to work again. An issue at the founding of this association, a position had taken to the central bank in terms of what are the merits of having such an association. And part of the argument that was put forward was that as an association, the association is expected to deal professionally from all aspects of its corporate etiquette. And that involves things like ensuring that there is adequate information flow. So for example, if as a corporate treasurer, I've done an offshore transaction and I'm expecting a huge inflow of dollars, probably maybe I've been able to secure a facility offshore, then I should owe it to the central bank responsibly to let them know that I'm expecting that kind of flow. And in a similar fashion, when we do have unanticipated huge demand, we owe it to the central bank to intimate them of that so they can adequately plan for it in their cash flows. What are your views as to, exactly how this relationship can blossom and fester so that there is direct and open transparency between members of the association and the central bank?
If I may go before the president, I think that first is the business perspective of it. What happens with most corporates is that when you have inflow, you want to sell to the parallel market. When you need dollars, you go to CBN. So until either CBN can have a unified rate where there is no arbitrage opportunity, it will be difficult for people to, for corporates to be sincere about what inflows they have. They'll on the demand side, they might be better at that, or they might bring that to the central bank in terms of planning and all of that. But on the inflow, I'm afraid, even if treasurers choose to, CEOs wanting that, CEOs would insist that they want more profits from that forex, and you get more margin if you sell in the parallel market. So I see CBN trying to block or trying to have a better hold on the parallel market, but yes, they can have a hold, they can monitor it, but you still can't change the margin. So until that unified rate is there, and then things will work out better.
I would also add that when you look at the core role of the corporate treasurer, amongst a lot of other things the corporate treasurer does is to manage cash flows, manage not just payments, but actually managing the cash flows, managing the risk around payments and cash flows around their business. And I think that this is one way that the central bank and the association can work together, as long as the association is able to assist its members to create systems in which managing this cash becomes highly predictable. Then the engagement with the central bank becomes a lot more productive, in the sense that it becomes easier for the corporate treasurer to foretell the cash flows in a very scientific way and then engage the CBN. And I remember it was a couple of years ago where the central bank was thinking along those lines, where if you forecast the cash flow demands, especially in foreign exchange, over a 6-month period, the central bank is able to plan. And the ability to forecast that is not as easy for the central bank as it is for the individual corporates. So as an association, if we're able to pull together the cash flow demands of the corporates over a period of time and engage the CBN on that level, so that they know that from the corporate world, this is the demand, this is what they need, and then they can meet that need. I think that synergy, there's a lot of room there for that type of synergy, because like Kudi said, a lot of interaction with the central bank is done at various levels. You have CEOs engaging the CBN, you have CFOs engaging the CBN, you have treasurers engaging the CBN. So what we need to do as an association is create a niche where the information that comes out of the association is unique to the trade world, and that information cannot be obtained by the CBN from any other source. And then that's where the key alignment would come from.
Thank you very much. And on this note, I'm going to start to summarize and wrap up the discussion today. I think it's been a very useful session, and undoubtedly you can see that the corporate treasury profession is indeed very challenging under these auspicious times. I don't think I'll be exaggerating if I said that the survival of many corporations will depend on the decisions made by these individuals, the person sitting in the role of the CFO or treasurer going forward. Risk management has become a paramount factor now in determining the future of many operations. And as I mentioned much earlier, even the best of business continuity plans, disaster recovery plans, would not have envisaged these sorts of situations and have been tested in ways that have been previously unimagined. And there are definitely a number of lessons that we can learn from the current situation. I think if I am to draw a parallel, this is almost like the situation that the capital market found itself in the dot-com era, coming out of the dot-com era, where a number of the stockbrokers had never seen a market that declined so rapidly in the dot-com era. The current situation, therefore, teaches us a number of lessons in the sense that the changing environment calls for more time and dedication to the tasks of cash and liquidity flow planning, dedication to managing cash flows and forex liquidity, and so on and so forth. I hope that the viewers have enjoyed this session, and I'd like to say a big thank you to each and every one of our panelists for sparing the time. This is actually prime time for a dealing period for most of them. I just want to thank everyone else who has logged on to participate in this webinar today. Thank you, Mr. President. Thank you to the Executive Secretary, Mr. Ajunwoko, for yielding the floor to be able to moderate this platform this afternoon. And on this note, in the absence of any further questions, I'd like to thank you all for your participation. Have a good day. Stay safe and stay safe.
Thank you.
Thank you.
Thank you, everyone.
Thank you.
Any comments from the Executive Secretary?
Yeah, just a kind of vote of thanks. We just wish to thank everybody, especially the moderator who has well articulated this panel session very well. We thank you. We also want to thank all the panelists for the insightful and enriching discussions that we had this afternoon. And also to all the attendees, we thank you for making our time to be part of this meeting. We appreciate your time and hope the discussions were of much value to you. And we also look forward to you obliging us when we do invite you in future for such things. Finally, I want also to inform all attendees that the membership of the Association of Corporate Treasurers is open to all treasurers of non-financial institutions. It is our wish that you all come on board. But if you wish to make any inquiry, though we have all your contacts, but if you wish to make inquiry about the membership, we will appreciate if you kindly look at the contacts that I have displayed, so that you can get in touch with us, and we'll tell you all about the membership of the association. Thank you, everybody. Thank you for being part of this. It has been successful. We thank you so much, and do enjoy the rest of your day. Thank you.
Thank you.
Thank you, everybody.
Thank you, everybody.
Thank you.